Hey everyone, so everyone thinks that China is falling apart, whether it's the real estate crisis making the news, the declining population data, the strict government interference into meddling in business and in life in general in China. There's a lot of reasons not to invest in China, but for those of you that can handle a little risk, let's see if Alibaba is just too cheap to ignore. Let me just start by saying that I'm going to be far more conservative with my estimates, especially for my growth estimates, and attempt to include this like Chinese discount that essentially the market gives to Chinese companies for all those reasons I just mentioned. Okay, I want to do the hardest thing first, which is estimate the future growth rates of Alibaba. And look, this is fraught with danger because it is very hard to predict the future, but we can get a feel. And what I do first is I'm looking at the quarterly report. And depending on what time of year you're watching this, just go and get the most recent quarterly report. I'll show you what I'm doing here. Now, I'm looking at the year-on-year change. So this is for the 3 months ended June 30, 2023. So I'm looking at what the revenue did from the quarter in 2022 to the same quarter in 2023, and revenues up 14%. Then we have income from operations up 70%, and we look at like diluted earnings per share, it's up 56%, and like non-GAAP numbers are at 48%. So there's a lot of growth year on year here. But if we went back just a quarter previously, some of these numbers would be actually negative growth. So it quarter by quarter, even 1 year compared to another year is going to have some like variations. So now I'm in TIKR, and what I want to do is I want to look over like a 5-year period. And in that 5-year period, let's think about what's happened. We've had Chinese regulations be like really interfere with Alibaba and their growth trajectory that they were on. We've had a pandemic where China was in severe lockdown. So that would have helped some of Alibaba's parts. It would have really hindered a lot of it as well. It doesn't get much more chaotic than probably the last 5 years. So evening that out is interesting to, I think, to see like what the growth rates would look like. So I'm going to look at the past 5 years, put it into a compounding growth rate calculator, and it's from 250 billion yuan to 868 over the 5 years, gives us a compounding growth rate for the revenue of 28%. So even though it was 14% year on year from the most recent quarter, maybe it has slowed down a little. Okay, from these great 28% growth rates. And then what I can do is I also want to look at the gross profit number. So it's gone from 144 to 320, 144 to 320 over the past 5 years. And let's get a feel for these numbers. Okay, we're at 17%. Okay, if I look at the cash flow statement, I'm going to look at cash from operations. We go from 125 up to just 200, 125 to 200 over the 5-year period. And we're looking at now about 10%. So even though revenue has been growing very significantly, the cash that the business has been producing hasn't been able to grow as quickly. So whether that will change or not change, if you look at cash from operations here, in 2021, it was at 231, I think that's trillion yuan, billion yuan. I don't know. I think it's billion yuan. And then it dropped down significantly in 2022 with the Chinese government crackdowns, and then they're back up again. So like, does this continue these growth rates? We're not really sure. So what I have done is I have used a what I would consider out of all those growth rate numbers we used, I looked at the lowest one, which was 10%. And I've just said, okay, let's just be conservative and say that they're going to grow out at 10% per year for the next 5 years, actually for the next 10 years. So even though they're splitting up the company into these different segments, some of them are going to grow faster, some of them are not going to grow as fast. I'm just going to say that because they're quite a big company, and China's maybe slowing down, but even though they have all these different avenues, let's just say 10% growth rate. Again, I'm going to adjust this as time goes on, as I get more information about Alibaba. But I think like the growth rates of some of the other companies we looked at like Tesla in the 30% range. We looked at Airbnb in sort of like 20% or 15%. A lot of those US mega cap companies, we used very aggressive growth rates. But for Alibaba, I want to be very conservative, mostly because I have a big investment in Alibaba. So the discount rate to find fair value We just put it at 10%, so we can, this is a little bit better than the S&P 500. It's where institutional money would still be interested at 10%. This is a fair valuation. Now, the multiple, instead of being in the 20x range, we're going to use 15. There's a bit of a China discount there at 15. The operating cash flow minus maintenance CapEx number. So how I found the free cash flow number is I actually just went to the quarterly reports, and just for the last 4 quarterly reports, searched the word free cash and found where it said free cash flow. So it tells me there that free cash flow was 39 million or 5.4 billion US dollars. And I just added the last 4 quarters to get me my free cash flow number, which got me to 20 billion US dollars. The shares outstanding number was easy to pull from TIKR. The total cash and total debt, I just pulled from the balance sheet. I just added up their short-term investments and their cash minus their debt. And it tells me that fair value is about $192 a share. This is the ADSs. This is in US dollars. Is 192 would be what we could call fair value. Now, as you can see, this isn't an exact science, and it's kind of always changing with the new information that we get. These calculations are going to require a lot of nuance, a lot of adjusting, a lot of research as well. With China, things are just dynamic anyway, and so the growth rates are going to have to be adjusted. And I'm going to keep track of all this in a weekly report called Yes Stocks, No Stocks. There's a link in the description for it. And you can get this each week for free. It isn't some boring newsletter. It's just straight into the valuations. No BS, there's no fluff. And I highly recommend you joining, as a lot of that hard work and heavy lifting has been done for you. Now, if I jump over into a 5-year valuation model, which is a little different way to do it. So what I've done is I put in the current revenue for Alibaba, and then a 5-year growth rate. I've used the same 10% growth rate. So we're turning 123 billion into nearly 200 billion. And then I'm putting the estimated free cash flow margin at 16%. It sits at about 16% now, so I'm happy to use that going forward. I think they will try to improve like the business, and those margins could improve, but let's just keep it as it is for now. The multiple on the free cash flow, I've just kept it. I've just made 15. Now, they are buying back stock faster than their stock compensation, so the share count is in decline, and they have said that they want to spend another sort of, I think it's $16 billion or so on share buybacks. So that number will continue going down over the next 5 years. I'm calling it just slightly down because that also factors in the stock-based comp. Shares outstanding number, current market cap at 224 billion at the moment. And we got a 5-year target price of 190, which is very similar to what we thought the fair value of the company was. So maybe in 5 years' time, we're looking at about $190, $200 range. And from the price that it is today, at around about $90 a share. Obviously, depending when you're looking at this, but I think the target share price in a very conservative way in 5 years' time. So what's that, 2028? We're looking at 190. So you get a 17% compound annual growth rate from today's price. Now, if we only wanted a 10% compound annual growth rate, what I would do is I'd just change the market cap, put it up a little bit higher, until we got to 10%. Okay, so 310 billion. And so the stock price could be significantly higher, around about 20%, 25% higher than the current price, which is around about $140 a share. And if we bought it $140 a share, that would be, I would consider fair value, because you're going to get about 10% per annum for the next 5 years till you get this target share price of 190. So based on these 2 methods, the DCF method, which tells us about $192 a share at the moment, the 5-year valuation about $140 a share. Both of those, at those prices, you could expect around 10% per annum after that. Somewhere in between those numbers is probably where fair value actually is. So let's call it $165, something like that. So now I'll go back to the DCF, and what I'll do is I'll put the discount rate to 22%, because that's what I'm actually looking for. So now I'm looking at a buy price, and I'm saying that at about $96, anything under $100, you could probably you're going to get somewhere between 15 and 25% per annum as a return if these growth rates hold up at 10% each, and their margins hold up and things like that. So I would say I've been quite conservative here. I would say that buying at under $100 is good value. And I think I have incorporated a bit of a Chinese discount with this. I've been conservative with growth rates, and I feel like this is a good ballpark valuation. Now you've seen how I worked out the valuation. Those growth rates I'm going to have to adjust with, those margins I'm going to have to adjust with. There's a few things I need to do quite regularly. Again, yes stocks, no stocks, link in the description for that. If you want to keep track of Alibaba and a range of other companies that I'm following, hopefully it's of interest to you, and hope you enjoy the video. I'll see you in the next one.